Good morning, everyone. Thank you for attending our panel here on monetary policy. This is, I think, our second time having a monetary policy panel at the London Summit, and it continues a tradition of monetary policy panels that we started at the Global Summit, I think potentially 4 years ago. I'm losing count, but something like 4 years ago. And I guess it's a tribute, as I always say in these panels, to the power of monetary policy a little bit in infiltrating a conference like the Milken Conference, which I always have viewed as a conference focusing more, obviously, on all the philanthropic issues, but more on the direct investment and the business outlook, and to have monetary policy have become such an important part of the business outlook and the asset price outlook is something that certainly came to fruition after 2008, and I think still sits with us today. And I don't imagine that it goes away anytime soon. And those folks who have tried to keep the global macro situation or the monetary policy situation out of their thinking when it comes to business investment, I think have found themselves in difficult places many times in the past. So I'm happy to be here with a very distinguished panel. I'm not going to spend an enormous amount of time introducing everyone. You have a booklet in front of you that shows who's up here and their bio. We have Wilhelm Beuter here on my right. We have Osame Mendeng. We have Robert Seminara, Stacy Warden from the Milken Institute, and Zach Summerscale at the end. And I'm going to just kick it off with questions and try to get the panel started in thinking about the question that was asked of us, which is, have central banks created asset bubbles? And I thought I'd kick it off with Wilhelm, who could start the conversation. Then we're going to bring in some others to follow up on the words of wisdom that come from your mouth. So please, do we have an asset bubble or not?
There'll be a long wait. Let me see. It's a pleasure to be here. The brief answer is no. Central banks didn't create asset bubbles. Asset bubbles are always made by the private sector. Central banks can feed them, contribute to them. And they have, but they basically had no choice. What we had is a big negative demand shock in the advanced economies, which made the warranted real risk-free rate seriously negative. Right? So in other words, the real interest rate that balances saving and investment at full employment. We couldn't get there because the nominal interest rate, the policy rate, was at effective lower bound, and the shock itself that gave us the negative warranted neutral real rate put downward pressure on inflation. So we couldn't get help from inflation either. So we're stuck. You need a demand shock to get out of it. External would be nice, but for the world, that's hard. Interplanetary trade is not what it used to be. Domestic, therefore, private, spontaneous private, don't wait for it. So it has to be public. Monetary or fiscal, in a sensible world, you use the one policy that always boosts demand and always gives you the inflation you want, which is helicopter money, combined monetary fiscal policy. That we couldn't do because in the euro area, fiscal policy is paralyzed by ideological anti-Keynesianism, and the helicopter money is made very complicated by the ban in the treaty on central bank funding of government deficits directly in the primary markets. And in the US, you can't do discretionary fiscal policy because the Congress is dysfunctional. So the two major Western areas could not do what needed to do. So the central banks were on their own, and they just flooded the world with liquidity, which is all they could do. Now, at that point, the private sector took over. We have the real interest rate, right, and the risk-free rate, and the risk-free nominal rate, both zero or negative, in some cases, real negative, as far as the eye can see, for long maturities. Say, in the euro area, 10-year real risk-free is negative. Now, the private sector grew up in a world where you could make a 7% benchmark on your portfolio, right? This was when the neutral policy rate, right, the risk-free policy rate, was 4%, 4.5%. That means you didn't have to make crazy risks to get 7. Today's world, when the neutral policy rate at the moment is probably still 0, right, the equivalent, right, risk would give you a return of 3 to 4% at most, and this was unacceptable. Right? So the private sector went into denial Either ignore the risk, there is no sovereign risk in Italy, there couldn't be, right? After all, they have grown in the last 15 years at a zero real rate on average. And that is really enough to offset the 2% or so real interest rate burden that they're looking at, right? Similar for other countries. And there can be no banking sector risk in the euro area because the stress test and AQR tell us that, I don't know, what is it, 8 billion, right? And change will take care of all the capital shortages. Never mind that Professor Acharya finds that for 39 of the listed banks, we have a 450 billion capital shortfall according to his methodology. Both numbers are wrong, incidentally, right? Because the point estimates are always wrong. But I know which one is closer to the truth, and it ain't the 8 billion. So a denial of risk and a rush into anything that yields a return, which because markets are inefficient, depress the risk premia. So we have a credit bubble, right? Publicly supported, but created by the private sector that cannot cope with the notion that the risk-free rate is zero, and that you therefore have to lower your sights.
You started by saying there's not a credit bubble, but you just
said
there is a credit bubble. Okay.
There is a credit bubble.
So there is a credit
bubble.
Yes,
there is a credit bubble.
Okay.
But that's the only bubble there is. So sovereign credit risk in the euro area, massively underpriced. US corporate credit risk, gone, right? Gone, girl. Banking sector risk, completely gone now that even the ECB and the EBA tell us that it's all fine. So there is this collective denial, and it's reflected in other markets as well. But equities, I think, are only generously valued because the discount rates, interest rates, are too low. I don't think the equity risk premium is ludicrously low, or that anticipated future dividend growth and earnings growth is way too optimistic, slightly too optimistic. But so that basically the overvaluation in equities that there is simply a reflection of the credit bubble. And this will burst, and I will tell you when it happens. Thank you.
So if I that's fantastic. I can't wait to hear that. If I understand what you're saying is that we have a credit market bubble. Yep. We don't necessarily have an equity market bubble. Equities will wobble a little bit.
Bubble.
It's a devised bubble from the credit markets.
Bubbles, yeah.
Although if you're right and equilibrium real rates are closer to zero than closer to
negative
2% real instead of or zero real instead of 2% real, then and that's the new equilibrium, then potentially one could argue that the credit markets are acting somewhat rationally to a lower equilibrium real rate, as Larry Summers
has
no
bubble in the risk-free rate. The risk-free rate is fine.
Okay.
That reflects the soggy reality we're in. It's the risk spread. So the central banks contribute to making both zero nominal risk-free rate as well as a zero, but the fundamentals generate the negative real risk-free rate.
So IG spreads at 50, 60 basis points, and you think that's a bubble?
Yes.
Okay, so more like 100, 120, we're okay.
Yeah.
All right, got it. Let's turn to Stacy. Stacy, what do you think about the potential for a bubble here? And maybe, I know you like to talk about some of the financial stability issues as well. Has the Fed created Fed and ECB and BOJ and Bank of England, have they contributed to financial instability in the future, which is not necessarily the credit bubble that Wilhelm was pointing to, but maybe some other lurking problem like we had in 2008, which is effectively lending to people that probably can't pay back, which is usually where every bubble ends up.
You know, I think the reason that we talk about targeting financial stability in the first place is that it's clear that in the conduct of monetary policy, central banks around the world have at least fed, if not contributed to a pernicious kind of bubble effect. And it's not just the first order price effects of asset price bubbles, it's also the misallocation of resources in the economy. So in Asia, you see this in the buildup of the export sector, the construction sector in the United States, and I would argue the size of the financial sector itself. And then when these bubbles burst, there are, of course, a loss in output problems. I think it was Martin Wolf that just did an estimate recently that the United States is 18% still below what output would have been in the absence of this crisis. Of course, slow growth and strain on government budget deficits. And so what does monetary policy do? Well, of course, it's first and foremost focused on making sure that these balance sheet banking sector effects don't redound back to the real economy and create a crisis. And central banks are quite good at managing these crises, and they've been very successful. But And so it goes, right? The way to do that is to lower interest rates again, and so you get into this kind of never-ending cycle. And the effects on the real economy, they've just not been, it just seems that with every crisis, central banks have to do more and more, and they get less and less for it, right? So the Fed has added $3.6 trillion of incremental liquidity to its balance sheet, and the US has seen $2.5 trillion in growth. Consumption is anemic. CapEx is about at 2000, net CapEx spending is about at 2000 levels. And so the change in thinking has been from, should, instead of the costs of cleaning up are clearly greater than certainly what Greenspan articulated. And so now should you kind of lean in rather than clean up afterwards? And I can talk about that in the next round of questions. I can just keep going about now.
Continue on that theme. I think that's certainly the financial stability theme.
Yeah, absolutely. Okay, so so there's an argument now that central banks should kind of get out in front of asset price bubbles and lean. And so you've got to think and to target some of these indicators: leverage, margin debt, repo market, credit spreads, et cetera. Mike Milken, in fact, keeps threatening to start a pick investor anonymous working group for people that, if the temptation just gets to be too much, you've got somebody else, to talk to. I read recently that U.S. margin debt is now about 2.5% of GDP. So there are definitely indicators out there. Willem talked about the price of credit. So the problem, though, with the lean model is that financial stability indicators are incredibly hard to understand and predict. So what is the objective function? We don't really know. How will these tools work? We don't really know. And as a corollary, as David has pointed out numerous times, how can we imagine that 20 academics in a room are kind of be able to get in front of markets where the market itself can't? And I would remind everybody that the macroeconomic models that policymakers are using today still do not have a fully articulated financial sector in those models. So until that happens, I'm a little bit cautious about that role.
I'm not sure they have a fully articulated economic sector either, but that's a different discussion.
Right. And then I think it's also important to keep in mind Minsky's kind of underlying observation, which is that it's the stability itself which increases risk-taking, which breeds instability. So how do you target, with those kind of caveats aside, if you do decide to go down that policy route, what do you actually do? Well, you can target interest rates, but that's kind of a blunt instrument, and there's some academic literature to suggest that raising interest rates in a bubble will make that bubble worse, so it's kind of violating the Hippocratic oath of monetary policy. So a lot more attention is now being paid to kind of macroprudential policies. And macroprudential policies are basically about getting the buffers there so that you can draw down on those buffers in bad times. And again, though, I would say, and that's targeting credit ratios, loan-to-value ratios, that kind of thing. But again, it's hard to imagine central bank policymakers sitting in a room kind of fine-tuning macroprudential requirements for market participants. And I'll just give you one anecdote. I think one of the most successful macroprudential policies has been the stress testing, in the United States and hopefully this time around in Europe. But Brookings did a symposium at the beginning of the year, and a number of the panelists cited that one of the main benefits of the stress testing in the United States was that the economists at the Fed had to talk to the regulators at the Fed, that it was such a big project that they actually had to work together on the same thing. So, and I think another, just to kind of finish up my point, another risk for targeting these kind of macro-pru indicators is that they're much more politically sensitive. I think that the central bank independence of monetary policy is much better established. And last, and I think most importantly, if you clog up the system with macroprudential regulations, then that makes the monetary policy transmission mechanism a little bit mucked up. So what does that mean? That means you have to lower interest rates even more to get kind of a bang for the buck. So you may be creating a kind of financial instability as you try to solve it. So, maybe this is a cop-out answer in the end, but I think you have to get the macroprudential environment right, but I don't know that it can be a kind of a fine-tuning policy tool.
It sounds like you're asking a lot, Stacy. Yeah. But let's turn to some other panelists. Asma, I know you have a number of thoughts on sort of where we've gotten to with central bank policy, and I know you have some pretty strong views on that we've gone a little too far, or maybe we've pushed a little further on a string that doesn't move very much. But how do you respond to the credit bubble issue that Wilhelm pointed out, and also maybe the macroprudential dilemma that the Fed and ECB face when setting monetary policy, that they want investment, they want to create aggregate demand, they want stimulus, but they don't want us to all get too happy and too crazy and do anything stupid. So how do you see this all working out?
No, thank you, and it's a pleasure to be here. I wanted to take up on Stacey's point about the effect of the policies we've seen on the real economy. And I think it's a point Willem made as well about basically the efficiency of policies that have been deployed since the crisis. And I'd like to take you back about 70 years. And many of you may know that we are celebrating the 70-year anniversary of the Bretton Woods conference that established the IMF in July 1944. And that was a point in time when there were certain key drivers and certain ideologies that have probably determined the sort of policy choices and policy frameworks that have been set up at the time and that still exercise huge influence on our thinking today. I would question whether this framework remains valid in today's sort of environment. We have, on the one hand, we had multilateral cooperation, so this was basically the peak of economic policy coordination back then, 70 years ago. I think today we are probably at a low. It was international integration, it was about globalization, and it was about the power of macroeconomic policies, monetary and fiscal policies. Now on the latter, I think, and coming back to the point, the efficiency of that policy, I think, needs to be called into question today. You look at the UK, for example, so since the crisis, 2008, the general debt of the general government debt of the UK has increased by about 50%, percentage points of GDP. The Bank of England has expanded considerably its balance sheet, and yet cumulative real output has increased by merely 1.5%. So we get very little bang for our buck, so to say. That is, policy efficiency is very low in the UK, probably, next to Japan and Spain, the lowest, actually. So I think we have to take a step back and say, these policies we have been deploying, are those really the right policies? And I think this is where we are. We are in an environment where these policies simply may not be effective anymore. At the same time, the risk of policy error is tremendous. Never have we been in an environment with such dominance of public policies in terms of debt and monetary expansion. And yet, the risk of policy error, that is, the Fed may get it wrong, the Bank of England may get it wrong, the ECB may get it wrong, and the repercussion of such errors are substantial. And I think those factors should make us much more cautious of whether we need more of the same, and therefore the risk that we are actually exacerbating the problem that in large part central banks have contributed to create, or whether we take a step back and we really need to think again, what is the sort of policy framework that is appropriate today? 70 years since Bretton Woods, I think it's a good time to think about that. Looking forward, there are many challenges that 70 years ago, nobody thought about it. One is certainly the integration of emerging markets into the global financial system. And I think a lot of the framework and policymakers' mindset is not at all geared up towards that. And I think this is why we have made so little progress today.
So let me ask you a question on that. Bretton Woods was largely a way to stop countries from cheating on one another by using monetary policy to gain competitive advantage. And like any other mechanism in the past, a peg or any exchange rate mechanism, it generally finds itself in a very unstable place because the incentive to cheat is always so high. So calling Bretton Woods a more efficient outcome is sort of like saying, yes, it's great that we could all cooperate, that's wonderful, or we can all hang around in an ohm circle and chant and be happy. But the honest truth is that countries will cheat, and they always have and they always will, and these things break. And what we've seen with QE, what we've seen with monetary policy, is kind of what we saw when we went off the gold standard in the 1930s. The countries who go off the fastest, the countries who cheat the most, are the ones who come out of the crisis the soonest. Yeah. And that storyline strikes me as one that you're not going to solve unless you can figure out how to solve what von Neumann and Morgenstern were trying to solve with the prisoner's dilemma game many, many years ago, which is finding an equilibrium in that very complicated game. So to go back to Bretton Woods is an extraordinarily difficult, well, I mean, in a utopia, wonderful. In the real world, I don't see it.
That. I think going back to what was an extreme rules-based framework that had its success, I think I'm not advocating that.
Okay.
But however, from a rules-based to a different type of frameworks, maybe more an incentive-based framework, which we haven't really managed to establish, is maybe where we need to be going. Because clearly, without any policy coordination, and this is where we are today, the outcome is very much like, it's likely to be much, much less effective than if we had greater policy coordination.
Let me ask you one other question, which is, I look at the U.S. economic performance, and we're taking QE away from the U.S. By Wednesday, we'll probably find out that QE is now done. And we're taking it away not because we have rampant inflation, not because we have, the QE created massive financial bubbles that are readily apparent. Maybe they're lurking in the sidelines, as Wilhelm suggests. It didn't contaminate the groundwater. It didn't create global warming. Not just on
the sidelines. I mean, the issues of payment-in-kind bonds, right? Ponzi bonds, is at an all-time record. The issuance of covenant-light loans, very light loans, at an all-time record. All kinds of leveraged products that I can't even begin to describe are appearing again, not so much in the banks, but in the shadow banking sector in the US. So I think there is a lot of froth. It is not yet 2006-7, but I really don't like where this is going.
If I look at it,
and the Fed is oblivious.
Total system credit in the United States, which peaked out at over 360% of GDP pre-crisis, is now back below 340% of GDP. So total system credit has come down. But I understand non-financial corporates have levered themselves up, and there's a couple of places where people got frothy.
But 360 at the peak was an insane number. 340 is still an insane number.
It's pretty much consistent with where everybody else is.
Yes, but the whole world is over-leveraged. What the world needs is a heavy dose of Islamic finance, right? Equitization of debt. I mean, there's far too much debt in the system.
But it's not the whole world, I think. That's also an important point to make.
If emerging markets, yes.
Yes.
It is.
But
The biggest explosion has been there.
Yeah.
There are very few countries that don't have, in Europe, in the advanced economies, don't have excessive government debt and still excessive banking sector debt. In the periphery, it is, and some countries housing, consumer, and then of course in the US it's beginning again with corporate credit. In emerging markets, it's corporate credit that's out of control. So I think it is really the addiction to debt is really frightening.
Well, we can come back to that in a second.
I guess it needs to be qualified. I think there's this very asymmetric distribution of debt in the world, and I think that needs to be reflected.
I guess what I would say is I'm not sure that anyone knows what the right equilibrium level of debt to income is for an economy.
It's a lot lower than it is.
Well, you say that, but I don't know. I don't think that 3x is necessarily a bad number. We see companies levering at 6 and 7x, and they survive. And I think Mike Milken always tells a story of a company in the 1970s that was issuing enormous amounts of debt, and everybody was questioning whether that company was going to survive. And I forget how much times, Mike will probably have the story, 10 times, 20 times, and people are like, oh my God, this is the craziest thing in the world in the 1970s. And it turned out that company was Exxon. Yeah. And you know what? They issued a lot of debt, but they had a lot of business that they saw in the future, and they leveraged themselves to a business model that made sense. I just say, I don't think we know the answer.
When you play Russian roulette, right? Yeah. 5 of the 6 times you're going to be fine. Right?
It's true. That is true. Why don't we go to the private equity world a little bit, where I know you can talk about 5 or 6 or 7 times leverage in a lot of the deals that are coming out, and certainly Jefferies has been part of some of the financing of those deals, so which we like to thank the bank regulators for, because the commercial banks don't seem to be able to do those as much as they used to. But where are you seeing the froth, the leverage, the worry that Wilhelm is putting there? And I know you look at the whole business cycle, and this is the part of the business cycle where things get frothy, I guess.
Yeah, sure. No, I'll jump in and largely agree with Willem, to be perfectly honest, which is, look, everybody saw the run-up in 2006, 2007, 2008. No one knew the trigger was coming. If you asked me before, okay, if Lehman goes bankrupt, will that take down the whole system? Nobody saw that coming. But people saw leverage levels going up, and you have to look at the incentives in the system. Okay, so as you see the deals getting sillier, If you don't print the deal and you're an investment bank, someone else prints the deal, and then suddenly you have zero revenue and somebody else got that revenue. And if you're an investment bank, if you're lucky, you print the deal, you have the commitment, the deal gets closed, and you syndicate that risk out to others. And so the whole game of it is to not be left when the bubble pops holding the bag. But if you're cautious and you don't write those commitments, then you're not even there to get lucky. And so there's an inherent incentive to take that risk as risk goes on. And as the monetary policy has shifted rates down, it's created increased pressure. So why has that happened? If you're a pension fund in the US, you're trying to get 8% returns. You can't do that anymore without taking risk. And there's numerous people across the system that are incented to get return. People hate sitting on money that's earning 0, 1, 2%. And so people are starting to ignore risk. And so 2006, 2007, 2008, bubble bursts, and suddenly you see a situation where everybody's saying, never again will we do covenant light. Never again will we lever companies over 6 times. Never again will we issue PIK debt. Never again is 3 to 5 years, because that's where we are. You're seeing the same silly deals happen again. And look, I think the central banks did exactly the right thing, which is the patient was dead on the table. And so you had to jumpstart the patient. And so they reduced rates, and there was a lot of activity, not just at the central bank level, but essentially they got the patient back alive again. And by the way, thank God they did. But now the issue is, okay, has the risk re-entered the system? Have we changed the incentives across the board? And are people creating this again? And look, we are seeing deals being done today at, on average, 10 times EBITDA. This is in the private equity world. And what was the price being done in 2007, 2008? 10 times. And by the way, Europe's economy is seeming a little in question right now. The European multiples are right on top of the US multiples, where I think people would say the US economy is doing better right now. So you're not even seeing a differentiation based on geography. And so we see that risk again. And we're not just seeing it in rock solid, stable companies. Are there companies out there that can handle 6, 7 times leverage? Yes, there are. Is it every company? No. Is it cyclical companies? No. And so, look, I don't know what's going to trigger the spark, but when a spark happens, there is so much risk being put back in the system that it'll be very ugly for many investors again. We've just raised a new fund, and look, we're sitting, investing very cautiously, very prudently, but if things turn, then that'll be a good event for us, right? We make, and most investors can make money with volatility, but if people right now are not pricing that volatility, they're going to get burnt, and it's just a matter of time till that trigger happens.
It's like the turkey that just is having this nice life, getting fatter and fatter and fatter, and there's no problem anywhere on the horizon, and then boom, Thanksgiving comes and it's all over.
Zach,
I may strike a slightly contrarian tone to this panel, because I think there's undoubtedly been signs of froth in the market. There's undoubtedly been signs. PIK toggles is a great example of just over-levered balance sheets where private equity is taking a lot of money off the table very quickly before they've done anything to the business. People are chasing this 7-8% mythical riskless yield, which clearly there's a lot of institutional clients, pension funds are after. But I'd argue that's very much still at the margin. I think that signs are coming of what's going to take us down for the next cycle. I think the signs are there. We look across the high yield market, and where you look at the average leverage levels around 4 times. So enterprise value is 10. The average leverage is about 4. That's not a bubble statistic. It may be a reason not to buy private equity deals today, but it's not a reason not to invest in credit. If you look at spreads, so the all-time tights on European high yield, 190 basis points. On the US was about 240. We're at 450 to 500 on high yield and loans today. So the spreads haven't come in. So to Willem's point, if you don't believe there's a bubble in the risk-free rate, actually the spreads on credit today look pretty attractive. And we think we're still in a lower default rate. That's not to say that we haven't seen exit. I think particularly first half of the year, we saw a lot of shocking deals. There was a massive chase for yield, and actually the last 3 months I think have been incredibly healthy, that we're seeing a pullback. People have lost money. I mean, one of the best examples in the UK, a company called Phones For You, which imploded overnight. The PIK toggle deal went down 70% in a day. Now that's not supposed to happen in credit. That's an equity story. That was never credit in the first place. This was a credit dressed up. Sorry, it was an equity dressed up as a credit deal, and we're seeing signs of that. Do I think that's endemic in the whole market? No. Do I think in terms of leverage statistics and spreads? I think the market overall, are there signs that people are chasing yield irrespective again? Yes. Yeah, there's certainly those signs, and I think the recent volatility is helpful for that we're seeing some of this risk off happen. Investors are losing money. And we talked earlier actually in the briefing room before this, what's the next big event, what's going to trigger it, none of us know. I'm not sure that's the right way to think about this. I think, credit's about idiosyncratic risk, ordinarily. It's about individual companies being over-levered, capital structures that should never have been underwritten in the first place, and you see deal by deal. I'm not sure that I'm a believer that every time there has to be a trigger, that there has to be a market-wide event. I think we'll just see companies with capital structures that shouldn't have been done falling down and going through the distress market, and that's what always used to happen, and suddenly everyone, because of Lehman's, now expects another massive event. I think that's, and I think everyone then expects the central banks to come in and bail them out again and provide a huge amount of liquidity, but I think that's the wrong way to think about it. It's about bad credit getting done, and people will lose money because they now see the central banks as a crutch, that they're always going to have this free option. Particularly, everyone's waiting for the ECB. I think they're going to be disappointed. The ECB will come in. It's not going to change anything fundamentally in Europe. It'll be a massive risk rally, but ultimately it doesn't change the fundamental problems in Europe. But overall, credit doesn't look expensive at the moment, but I think there are signs of that froth emerging. I don't think we're anywhere close to 06 or 07.
I couldn't agree more. But I want to come back to Wilhelm's point about the Fed or the ECB or the central banks not creating bubbles, the private sector creating the bubbles. And in a sense, central banks only change our incentives. They don't do anything. Ben Bernanke doesn't get in a room and invent the next great widget that we all want to buy. He just takes everybody in this room and says, you know what, if you're going to sit there in cash, I'm going to charge you a tax. It's a negative real interest rate. You're going to have to buy a T-bill. Inflation's going to run at 2%, and you're going to lose 2% of your real wealth every year. So all of our incentives are to go out and take risk. That's basically what monetary policy did in the response to 2008, and we did. In the US, we went out and took risk. We invested in shale gas, we invested in biotech, we invested in communications technology, all the things that the central bank asked us to do, we did, and we did it actually without asking Nancy Pelosi where we should go invest. We actually did it where the invisible hand took us, which was kind of the right thing to do, not relying on fiscal policy to choose winners and losers, but relying on the markets to pick winners and losers and incentivizing them to pick once again when they didn't want to. So to me, to sort of look back at monetary policy critically and say that it operated ineffectively or created some sort of bad outcome, this is exactly what these guys set out to do, and it's exactly what got us to the point where we're actually, in the US at least, growing reasonably sustainably and creating a reasonable outcome. Why is it?
They were forced to do it, I think they had no choice, because fiscal policy was paralyzed, right? In the US, fiscal policy is cyclically appropriate at the moment by accident, right? Because it's happened that the Congress sort of locked in at a level that is at the moment right. If we ever need a fiscal stimulus in the US, say the economy were to slow down unexpectedly, how are we going to get it?
We
won't.
doubled the amount of marketable debt outstanding in the United States since the crisis, so that was a pretty big expansion.
No, you had a fiscal stimulus, but since the Congress sort of collapsed in partisan infantility, I think there has been a paralysis of fiscal policy, which is comparable to, very different in origin from what we see in Europe. In Europe, it's ideology largely, or inability to fund yourself. In the US, it's fiscal gridlock in the Congress. Now, I think what central banks could be blamed for, though, is that they still don't believe and act as if, and some explicitly deny, that there is a financial stability role for interest rates, right? And that is rationalized, especially by Janet Yellen, with the fact that, if there were financial instability, and she sees a little bit of, a froth somewhere, leveraged loans and all that, that's when you use macroprudential policies. But what she and also refer to as macroprudential policies are not policies that lean against the financial cycle. These are simply stronger financial institutions, right? Stress testing, higher capital ratios, more liquidity. I'm all in favor of that. Motherhood and apple pie. It may make financial crises and bubbles less likely, and when they burst, you may be more robust, the damage may be less, but it is not what I would call counter-cyclical macroprudential policies. The US has no counter-cyclical macroprudential policies, no counter-cyclical loan-to-value ratios for mortgages. They have one instrument, the Fed. It hasn't been used in 40 years, but it's margin requirements for stocks. Right? That's the only macroprudential policy.
And reserve
instrument.
requirements that haven't been used in
but
banks
that's
as
not
well.
really that's a conventional monetary policy requirement, I would see. Okay, but
you
if you
could
want to
move
call that
them,
macroprudential, yeah, that's fine.
You could call that
They could use that, yes. So
They did it
I
in the
really
Great
think
Depression.
there's a problem. If you say we use macroprudential policy and you simply mean stronger financial institutions, then you run the risk of feeding the recklessness of the private sector, because they know that they're not going to get ambushed by rate increases because credit is running away.
But Willem, what makes this environment so hard is that you've got low inflation, disinflation threats, anemic growth, and asset price bubbles. So, you know, it's what's the policy?
Nice to have macroprudential instrument, but if you don't, ultimately financial stability is a precondition for macroeconomic stability, right? In the longer run, if you don't establish financial stability, then the dual mandate goes out of the window as well, because you'll have a massive bubble, it bursts, massive recession, and you have unemployment and deflation.
Right, but given where we are now, what?
I think there's a case can be made, and Jeremy Stein made it, that the US monetary authorities should be ready to raise rates for financial stability reasons, even if it was not warranted, and he recognized it wasn't, for either of the dual mandate, maximum employment, price stability reasons. I don't know whether we're there yet, but I think that's a debate that, well, sort of has been had, and Mrs. Janet tells us we're not there. We use macroprudential first, and I said, but you don't have any macroprudential instruments.
Yeah. But I think, isn't there a contradiction between what Stacey's saying and what you're saying? You seem to believe that macro policy is still effective. Stacey, you seem to be suggesting that it is no longer effective.
No, I'm not saying that.
And is it really effective? Because if you look at the growth record we have had since the crisis, I think
macroprudential policies, I think, can always be arbitraged, and that was, because they're regulatory in nature, right, or fiscal perhaps. So they can always be arbitraged, and but they can't be perfectly arbitraged. And I can tell you, it's hard to see a big bubble that hasn't had a housing boom and a mortgage, over-leveraged mortgages associated with it. So if you can somehow take care of, if you will, of mortgages countercyclically and of the stock market through margin requirements, then I think you will have something to supplement policies.
We had a tech bubble take place at relatively high interest rates.
Was it leveraged?
It was leveraged in the structure of the PEs of the tech companies that people were buying, and the Pets.com sock puppet was pretty heavily leveraged, I think. But I mean, and that bubble actually didn't create a lot of systemic risks, as you rightly point out, I think, in thinking about housing. But you also had a commercial real estate bust in the early 80s that did have some systemic risk. So when it's levered into real estate, it seems to have a bigger
that
impact
seems to be the danger point always.
than in other types of bubbles. And I guess I fall back on this argument of why do you think people are going to do less stupid things at lower interest rates? I look back on 1998 in particular. We had a hedge fund that almost took down the world by levering everything they could under the sun 100 times. Small spreads in AAA space, levered over and over, and interest rates were 5.25%. There's nothing that stops people from levering up at a stupid way because rates are low or rates are high. So to me, Jeremy Stein's argument of saying, hey, we need to raise rates to stop the leverage bubble is a completely, it's a very myopic statement in my mind.
I don't think so. I think the private sector simply goes into cognitive dissonance about risk when the risk-free rate is incredibly low. Because it simply cannot live with the notion that the maximal acceptable risk that you can take will not yield you more than 3 or 4% in your portfolio, right? That's just, and so that risk simply gets
illusion.
not priced at all, risks that should give 500 basis point margins go at 200, and that's what, so it is more dangerous at low rates. But you can have a bubble at any level of rates. That's true.
But if you raise rates, you actually can make credit more attractive. I mean, people will then easier get to this kind of 7-8%. People will want more going into. I don't think necessarily raising rates just stops people making stupid decisions in lending. I just don't think that policy will result necessarily in a massive improvement in credit quality.
So let's turn the discussion to Europe, because the European situation has probably been one that has confounded almost all of us on monetary policy as watchers. The ECB's balance sheet has contracted measurably since the end of 2012, while virtually every other central bank's balance sheet has expanded quite aggressively. Up until June, the euro had peaked out at a very strong level of 140. I guess, you sit in the European credit markets, Zach. How do you think about ECB policy affecting the credit markets? How do you think about what's next for Mario Draghi and what that means for the potential for performance in the assets, and whether we're sort of a few years away from a credit bubble being started in Europe, or how we would even look at a credit bubble being started in Europe? Because clearly, well, maybe away from the private equity world, as you pointed out, Robert, certainly in the bond markets, it doesn't appear to be that way. But is that something we should be thinking about, and something that we should be predicting with ECB policy looking set to move more aggressively?
Yeah, I think that's the danger for next year, is if we do see QE in whichever form, and everyone is expecting the ECB, their hand to be forced, that none of these policies are working. The TLTROs clearly has been a massive failure. I suspect December is a bit of a failure as well, and then they'll be forced in the first quarter, is my view, to do something more aggressive. And the risk of that is they start buying all these other asset classes, and it forces people to take on more and more risk. People will chase yield in those kind of environments. But it doesn't sort out any of the kind of fundamental structural issues within Europe, and you have hugely different in terms of the structural issues across the southern and northern Europe, the uncompetitiveness, the labour market. I was actually sitting into some of the crossroads in Europe, which was more like a car crash in Europe, which was the kind of tone of that panel for those of you that were in it. But there are fundamental issues. My analogy kind of is, you don't give a naughty school kid punishment by giving them more pocket money. And I think that's what QE kind of ends up doing, is you end up just deferring the problem longer. People have more time to do bad policy, and then you end up with a bigger problem further down the line. I would rather you see some more fundamental changes within the European economies than everyone just is waiting for this crutch of huge amount of QE and suddenly everything's all right in Europe. I don't believe it.
I mean, I guess the ECB is out there telling us we want more lending, we're trying to free up banks' balance sheets. That's part of the stress test. We're going to go out and buy covered bonds. We're going to go out and buy sort of assets that would hopefully disseminate credit to the masses. But then we turn around in the U.S., and after we've done all of these credit-enhancing policies, we have a panel full of people sort of saying, this is crazy. We've lent money to people who we never should have lent money to. How do you get this right in Europe?
But I think the issue is people don't want to borrow money if they don't see growth. So, you've clearly got the financial engineering, which is one side, and the LBOs, but ultimately the SMEs, if you don't see growth, what the last thing you want to do, and that's the issue, is they're not attacking the kind of structural issues in terms of growth within Europe and making a more competitive economy. If you just throw money at it, it doesn't work. I don't think it will work. I don't think these policy tools will end up with the European economy coming into boom just because they do QE. Suddenly, that's an nirvana. Clearly, that's what the markets are putting pressure on. I don't think that's the solution for Europe.
Yeah, I'm reminded of an orchestra where the central bankers are the horn section. The entire orchestra goes off key. The string section goes off key. There's no structural reform. There's no growth. There's bad fiscal. Now the horn section can either continue to play on key all by itself while the orchestra is going off in this direction, or does it change key and try to kind of at least lessen the musical dissonance by playing along, right? And I would say one thing. The one thing on Europe is that when England and Japan went through QE, they got a 20% depreciation in the real exchange rate, trade-weighted exchange rate, and I don't see how Europe is going to be able to affect that. Yeah. And that.
Wilhelm, on Europe?
Euro area, I should say, is a tragedy. It's a train wreck in slow motion. It's completely self-inflicted. Right? It's a massive four-dimensional policy screw-up. And you have to move on four fronts to do something about it. First, you have to redo the stress test and the asset quality review. and really recapitalize the banking system so that if and when animal spirits revive, the banking sector doesn't become a brake on growth. At the moment, even though it's zombified, as you say, it probably is the demand for credit that is the binding constraint. But if we ever get our mojo back in the euro area, the banking sector is incapable of supporting growth. So it's important to get that right. Then you need to have you need helicopter money. You need a fiscal stimulus where the output gap is widest. That's in the periphery, not in Germany. Germany has the smallest output gap. There's a very weak Keynesian argument for a stimulus in Germany. Where you want the stimulus is in Spain, in Ireland, in Italy, in Portugal, in Greece, where the output gaps are widest. They can't afford it, so you have to monetize it. And that means you have to fiddle the treaty. You have the ECB doing QE, sort of for monetary reasons, at the same time that the Commission relaxes the fiscal constraints on the periphery, who then borrow, and as part of its QE, so you do $500 billion, 20% goes to Italy, that's 100 billion of Italian debt taken out of the market, so they can put it back in without spooking the market. But then, of course, that's not enough, right? So monetary expansion, yes. How the ECB shrunk its balance sheet, starting the day after Mario Monti said, whatever it takes. If you look at the balance sheets of the euro system, it peaked on the 27th of July 2012, and trillions gone off. This is insane. And when they then ask you, why did you do that? It wasn't us, Gov, it was them. It was the banks repaying their LTROs. It's endogenous. Yes, Econ 101. You set the price, the quantity is endogenous. You want a particular quantity, you better accept the price that it is required. This is just such a weak excuse. People should be taken out and shot after a fair trial for making it, right? So, but it's not enough to have the fiscal monetary system, which you need the structural reforms. Without that, countries like Italy have a potential output growth rate, which my team estimates at 0.5%, and because I'm Dutch, estimated at 0, right? And that means things aren't sustainable. Right? The debt Italy's public debt is not sustainable unless they have a supply-side revolution. And I say revolution because a whole bunch of entrenched rights, right, so-called employment protection policies that in fact are incumbent protection, employment destroying policies, have to be canned and revised. Without that, the continent is headed for cyclical stagnation turning into secular stagnation. It's the only part of the world where this is a material risk. And it is completely unnecessary.
So if magically the ECB could figure out how to take the euro down to parity with the dollar.
Not enough.
Still not enough.
No. Anyway, globally it's beggar thy neighbor, right? It redistributes the pie.
But we need to actually remove accommodation. We would like a stronger dollar here.
It would have it would do a bit of good, but if you look at recent experiences with sharp depreciation of the currency, everything has responded except exports, right? We had it in the UK after 2009, 25% real effective depreciation. Nothing happened in the exports. Japan.
But huge investment changes, right?
In the UK?
Yeah, look at the City of London, cranes and buildings everywhere in the last 6 years.
In the UK.
Property markets on fire.
In the UK in 2013, total capex was 14% of GDP.
Investment.
But okay, that's it. But I mean, I'm looking at investment in stuff that is not just sort of oligarch accommodation, right? So actually,
man, wherever it comes from, you take it, right?
But productive investment would be nice too. I'm not against.
But this is a nice building.
Yes, no, it's lovely. Although it has these silly elevators, right?
But I think it's not about consumption, it's about investment.
It's about investment,
exactly.
yes.
And that didn't happen.
And investment is now growing in the UK again, but from an unbelievably low base. 14% of GDP. I mean, it makes Germany look like China, and Germany is ridiculously low at 18.
You've seen it into asset markets more than you've seen it into capital expenditures.
Yes,
sure.
no, because the liquidity trap is not perfect, right? Some of the excess liquidity doesn't just sit on the balance sheet of the central bank and the banks, it leaks into the most liquid other assets, the exchange rate and stocks. And that has some effect on the real economy, but it is poor man's monetary policy. Once the interest rates are at a zero lower bound, shoveling out liquidity through the balance sheet, especially when markets are orderly, does some good, but very little.
Can the
And some,
ECB create a recovery in the south of Europe, a sustainable recovery in the south of
Not on
Europe,
its own.
without creating a bubble in Germany?
It can't do it at all. Not on its own.
There's no way to do it?
No.
You can't take the exchange rate down far enough to make it all go away?
No, because
You might hurt somebody else, but you could do
it has to be the real exchange rate that goes down, and if you got it down far enough, you would probably get inflation. No, I don't think the volumes would be there. The volume response would be there, even if they got the exchange rate way down. And it would be a response anyway in the Western world. You couldn't bring the real exchange rate down by 30–40%. That would lead to Congress passing, what is it?
Some
what do they call
WTO
it?
action would probably happen, yeah.
Currency manipulation. Currency manipulation. So no, I don't think it can be. It needs a combined fiscal monetary stimulus, and without on the demand side, and of course on the supply side, we need really Renzi squared, right? And well, Hollande to the 500th power. And they still have nothing.
Scary. We have a few minutes left, and I wanted to get back to the private equity world, because I thought you had some great comments on the leverage in the private equity world, and I thought Zach made some great points on sort of the high yield market at 4 and IG spreads and high yield spreads, both in the US and Europe, not at levels that we would typically associate with sort of significant overheating. You obviously spend a lot of time looking at the cycle and when is the right time to invest. These are levels that you would sort of basically put pari passu with levels we were seeing in 2007 and 2008 for the typical private equity deal that's getting done in the United States and Europe in terms of leverage?
In terms of leverage, yes. In terms of purchase price, yes. The size of the deals are actually smaller today. But the companies, I don't think, are fundamentally different. So, look, I think I agree with I actually think our points, we don't necessarily disagree.
No,
I think in the right capital structures, the risk premiums are there, and you are having the right risk, and people are thinking of it the right way. I just don't think that's the norm. And so I think there are significant outliers to those, and those bad capital structures will get punished. Now, ultimately, what happens? I don't think it's another financial crisis. I think the one good news is that the banks are not holding as much exposure as they were, right? So you don't have the 30.
Is there any bank that has a PIK bond?
I mean, I can't say I know every single bank's balance sheet, but
Pretty
largely things have been syndicated. And so, and by the way, you're also not having the size deal. So a $30 billion deal, that's a lot of money, and you add up 3, 4, 5 of those that are in the market at the same time, and simultaneously the market crashes. That's when you have an issue.
Right.
And by the way, of course, also they were taking the same risk in 17 other markets. So it wasn't just private equity alone taking it down. I think what's happening now is the deal sizes are smaller. So if the music stops, it's not going to bring down the system, but it will bring down specific companies. And look, that's the way an orderly market works, right? The distressed guys come in, they buy the companies, they restructure the balance sheets. And that's the beauty of the system. But to think that it's not going to happen again, and to think that every single deal being priced today is responsible, I think is a fallacy.
So why do you think there's such a disconnect between the private equity world and what people are willingly accepting in terms of leverage and price and what's being transacted in the IG and high yield credit world? Is it just that sort of reach for anything close to 8, and they're willing to just do stupid things there, and that's why the deals are so
I think it's
so poorly
it's a
priced?
few issues. One is you've raised capital, and if you don't use it, you lose it, and a lot of money is coming towards the end of the fund life. And by the way, I think it's also been enough of a cycle right now where people have gotten rewarded. So you saw a deal being done that was, you thought, overpriced at 8 times, but then the guy was lucky, and what do you know, a year or two later they sold it at 9 times. And then, by the way, the person who bought it at 9 times then sold it a year or two later at 10 times. And so you're seeing people, still being able to sell while the music's still playing. And that breeds into itself. And so it becomes a point where markets get overheated, right? This is no different than any other market out there. And so the question is, when will the music stop, and how big of a position do you want? That doesn't mean don't invest. You could still deploy capital today if you find your spots at responsible multiples. But just the average right now, the market in total, if you're going to look at the aggregate market, then you're going to see things that are overpriced. We, in the last 2 years, have sold $33 billion of assets. By the way, our average selling price was somewhere between 9 and 10 times EBITDA.
Right.
And we've been buying, we put to work $8 billion, okay? And so obviously we're selling more than we're buying. I think that's reflective of our market view, but the $8 billion we put to work, the average multiple is between 6 and 7 times EBITDA. And so you have to find ways to kind of pick your spot. Now, that's a very different question than where's the average market today.
Right.
And look, if you're right and you time it and you exit before the music stops, guess what? You'll make a lot of money, you'll look smart, you'll look great, and people will say, what a brilliant investor. But the question is that a lucky move or is that smart? And can you rely on that luck?
Well, look, we're ticking down to the last seconds. I want to thank our esteemed panel for a great discussion. If there's one thing that I would take away, it's that the idea that there are bubbles in financial markets being created by central banks is still a very controversial view, and I expect that it will be a debate that continues for many, many years. Thanks, everyone, for attending.
Thanks, David.
Good.